Hello and welcome everyone to the show, our Quant Insider podcast. Today we have Kristopher with us. Kristopher has over 24 years of experience in volatility trading, and today we will be discussing about volatility trading. He started his career at SIG and then run his own market making team, even managed commodities option book for a major volatility fund. These days, he run Moontower newsletter where he shares his experience, his knowledge related to options, and he's also started his own option analytics tool, moontower.ai, and we'll discuss about that as well. So yeah.
Thanks for having me on.
Yeah, fantastic. So today we are going to discuss on volatility trading, right? So can you just tell how did you get started in trading, at what stage of a career or in college you got interested in trading or even in options?
Yeah, it was in college that I first got interested. My mother worked at she spent her entire career working in the back office of a treasury department in a Canadian bank. This was in New York. So in my summer internships when I was in high school, I would go from New Jersey to New York City during the summertime, and I would do things like just sort mail and stuff like that. But there was a trading room that was behind glass, and I would bring the traders lunch, and I would always try to talk to them, and I just found them to be very interesting people, and I knew that they made a lot of money, and so all of that just attracted me to it. And then when I was in college, that was in high school, and then when I was in college, I ended up studying economics and then doing internships. I ended up doing an internship on emerging markets exotic derivatives desk where I didn't understand anything of what was happening around me, but same thing, I was more enamored of these people that were making lots of money. That was at DLJ, which ended up getting acquired, I guess, by Credit Suisse. And this is in the late 90s. And from there, I realized that I might have some interest in going into trading. And then SIG was recruiting at Cornell. And at that time, in those days, the market maker firms were not really known. So there was nobody at their booth. Everybody wanted to be a banker. Everybody was over at the Morgan Stanley and Goldman Sachs booth, and this trading was not really on everybody's radar in the same way that it is today. So I just happened to be standing there, and the recruiter kind of called me over. I looked a little lost, and he started explaining what they do and how they play games and all that. And I said, "Well, that sounds like that sounds like fun." So they didn't seem to care that you didn't understand like what interest rates are. I mean, I kind of knew a little bit of that stuff, but like they didn't seem to care that much about that. And that in itself fascinated me. Like, wow, they don't really care about your knowledge of markets, and they wanted to teach you how to think about games. So that was how I got into it. Like I was just on campus recruiting, and I ended up getting through their interview process.
Okay, that sounds interesting. So can you just explain in simple language what is volatility trading for our viewers, why it matters, and how different players in the market approach vol trading? Like volatility trading might sound niche, but it is becoming increasingly important in today's market. We have seen how volatility can grab headlines. Think of an event like 2018 Volma Dawn, when popular short volatility product imploded and shocked a lot of traders, right? So can you just give a brief about volatility trading?
Yeah, so volatility trading so we should back up and call it for a moment and call it what it really is, which is it's options trading. So the idea is um there's option contracts that are if we think about how an option contract is priced, it has a number of inputs, including the stock price, the strike price, and the difference between them is the idea is called moneyness, how far the stock is from the strike price. There's an interest rate component to it, and then there's a time to expiration component to it. Um, all of those variables are fairly observable. You can look at the yield curve and you know the interest rate. You can look up this, you could see what the bid ask on the stock price is, and you can see where the stock is. The strike price is fixed, and the time to expiration is also fixed by the exchange. The only variable that goes into the option price that has an area for large disagreement is the volatility. And as you can imagine, an option on a very, very volatile stock will be worth much, much more than an option, say, on a utility company. So, but because we don't know what the actual volatility will be for that underlying for the stock, there's an opportunity here to reflect a view on the volatility. Either one of two ways. Really, we can think of it in two different ways. There's the implied volatility, which is to give an example of implied volatility. If we are looking at a stock right now, let's say you're looking at the money call. If right now, if all of a sudden nothing changes in the stock price, and in 1 minute, the at-the-money call's value goes up, let's say that it's $3 and it goes to $3.10 suddenly, with the stock not moving or anything, the only thing that could have really changed that caused it to go up by 10 cents is the market's consensus forecast of what the volatility is. So the volatility has changed, and in this case, it's changed the option price by 3%. So that is a change in implied volatility. So an options trader could try to buy option contracts where they think the implied volatility is going to increase, or sell ones that they think the implied volatility is going to decrease, or they could do what we call replication, where they buy an option and they say, over the course of its life, I think that the volatility that's going to transpire between now and the expiration is going to be higher than the volatility that I bought, that was implied in the contract that I bought. So what they can do is they can buy the option, and then they can replicate the option, a short option, by trading the underlying stock, and try to essentially monetize that difference by holding it. So the two things is you can bet on the implied volatility, or you can warehouse the trade and replicate it and hold it till expiration and try to make money on what we call the realized volatility. So that's those are two very high level, broad categories of what volatility trading is. And people that volatility trade for a living are doing a mix of both.
Can you just put some light on relative value in volatility trading?
So a relative value in volatility trading could have to do with, let's just take a very narrow example where you may have a number of stocks that have a high correlation to one another, but in other words, those stocks are governed by much of the same underlying economic principles. There's some, we think about the world, if we think about the stock market as having, these ideas of systematic risk and idiosyncratic risk. And then if you were to look at the sector level, there are groups of stocks that have overlapping or a more concentrated version of systematic risks. For example, like the sector of semiconductors. So they're not only exposed to the economy, but they're exposed to the entire business of selling chips in that ecosystem. So those stocks are kind of behave together. But those stocks will also, and then they each have some idiosyncratic volatility as well. Every one of these companies is different, has different customers, has different management. So the volatility between these stocks can vary based upon whether end investors are buying or selling certain stocks in the name. End investors are discerning between these stocks, and they're saying, well, I think that this stock, I want to buy this stock. There's flows, basically. I want to buy this stock. I want to sell that stock. I think this one's going to outperform. And all of that may manifest itself in terms of changing realized volatilities between the stocks, and also changing implied volatilities if those investors decide to reflect their views using options. So because of these flow disparities, we can get options that look relatively cheap or relatively expensive compared to one another within the sector. So part of the relative value lens is that there is some underlying reason for these things to be correlated in the first place.
So can you just tell a matrix that you use or in general it is like industry uses for like deciding if it's uh the premiums are cheap or expensive, because some people use as basic as an implied volatility percentile or a rank, right, to get if it's cheap or expensive as compared to old terms. That's one way, but what are the other ways someone can decide if the premium is cheap or expensive, or the wall is cheap or expensive?
Yeah, so one of the this kind of comes back to a little bit of from training. There is a sort of have a fundamental belief that the more liquid a market is, the more efficient the market is. So one thing we can do is say we can look at very, very liquid markets and say these markets are assigning they have volatility surfaces. They are assigning what we'd call parameters to the price of volatility. For example, if the market is anticipating, let's take an example. We're in a normal market situation, but the upcoming payrolls number is anticipated to be a number that is important to the market. And we know it's important to the market because the marketplace is bid up the options that expire around the payroll number. So we don't even need to rely on our own sense of like, is this payroll number important? We can import that opinion from looking at the marketplace and saying, look, these options are expensive compared to the options ahead of them. Now, if you were very naive about this, you would look at that and be like, look, those options are so expensive, and the ones that expire a week later look so cheap relatively. I'm going to sell the ones that are high and buy the ones that are low. But that, like I said, that's naive. The reality is the market is pricing in the fact that we're going to move on that payroll number. So there is an excess move size compared to a normal day being priced into that. So if we look at liquid markets, they can tell us a lot about what the market thinks. They can tell us what the various price of parameters are. They can tell us the price of skew. They can tell us what the right term structure could look like, or what your baseline assumption of what a term structure should look like. So you can construct a cross-sectional view of the world and say I'm going to basically calibrate what I think are fair volatility surfaces to liquid names. And then from there, I can then look at what is an anomaly, what stands out compared, like how is this term structure in stock ABC priced compared to the broader market, or perhaps its own sector, or the bellwethers in that sector. And then you can reason about, and then this is where the context is important. You can then reason about, are these differentials, do they seem warranted? That's where research comes into it. You might have to go investigate and say, oh, this name seems to look very expensive. And then you could look into it and be like, oh, it's going to be having, there's some important product announcement that it's kind of expected, and that's why it looks like that. So it's a mix of the quantitative things are used to measure and normalize. And then you have your qualitative things, which is the context that you bring to bear on what the quantitative metrics have allowed to stand out.
Got it. So, as per you, what are the common conceptions that retail trader have regarding vol trading? One of them is that if there is spike in volatility, you just sell the vol. That's a very common misconception which I've heard a lot of people talking about. So, what, as per you, it's they have wrong misconception, and instead of those, what they should focus on?
Yeah, so I would say the first misconception, that's a great misconception, by the way. And that's a misconception that exists. It's not just in options, it's in all markets. The idea that if the price goes up, that it is expensive, and if the price goes down, it is cheap. But we know just from basic understanding of investing that doesn't necessarily need to be true. If a stock goes up 10%, but its expected growth rate has went from 10% a year to 30% a year, I would argue that the stock is cheap, that it going up 10% in one shot is probably not enough to, it's not enough of a premium to the fact that now this stock is expected to grow at 30% a year. This is the same thing with options. To say that what happens with options is when vol is on the very low end of its range, it will tend to trade expensive compared to how it's realized, because there's an assumption of mean reversion baked into the market. Volatility itself is a mean reverting property. We don't know how fast it's going to mean revert. I mean, vol can, if you take a year like 2017, the implied vol can stay, and the realized vol can stay subdued for a long period of time. And when vol goes up, it can stay elevated for a long time. And we only have to look at the GFC to see how long vol can stay elevated. So the idea that high vol is a sell and low vol is a buy ignores the fact that low vol is always coincident with the realized vol being even lower. And that's because the market is always saying, well, I know that the realized vol is 6 in the S&P, but we don't expect it to be 6 forever. So the fair IV might be 8 or 9. So if you buy that low vol of 8 or 9, a 1-month option for 8 or 9 vol, and you continue to realize 6 for the next month, they're going to lose on that option. So it's not so simple. In other words, like the market is adjusting, and vice versa. It's true on the other side. When vol gets very, very expensive because the market has started to move around a lot, the market does not just amortize that those current high vol moves and say, oh, this is now what this stock is forever, that this stock is always going to move. This is a 20 vol stock that's now moving 35 vol, and we're just going to say, you know what, a 1-year option should be 35 vol. That's never going to happen. So what happens is, if you sell, maybe that vol goes from 20 to 25. So what happens is you go and you sell this vol that looks expensive because you said, wow, vol went from 20 to 25. It's up a lot. The problem is all that period of time when the stock is realizing 35, you're losing carry. So the trade-off is always the carry versus the directional aspect. When you buy cheap vol, you're almost always losing on carry, and you're winning on actuarially on the fact that you think vol is going to go up. But the timing, the rate at which it goes up versus how long the realized stays subdued is going to determine your P&L. And the market is such that it will price options in a way that will, what I like to say, there's no easy trades. I mean, if the market, if S&P vol, when the realized got to 6, if they priced vol at 6, that would be an easy trade. Just buy 6 vol, because you're already about as low as vol can go, and you have upside directionally speaking, and you have almost no cost owning that. That would be an easy trade. The market does not just offer you easy trades like that. So for retail traders, and like this is what our tool does, is we use this cross-sectional lens to say, let's look at everything and say, we expect high vol names or high realized vol names to have a discounted vol. And we expect low realized vol names to have a vol premium to that realized. Even though the IV is low, it's still premium to the realized. We expect that already. That's not what we call an opportunity. So if you were to look at this on a chart, it looks like a diagonal line. Low vol, low realized vol, high implied vol, relatively speaking, to the realized, and vice versa. Everything that's near the diagonal line is sort of what we expect. So what's interesting is things that lie off the diagonal. So things that are in the upper right quadrant of this sort of visual that I've painted, and things that are in the lower left quadrant being low vols that are or low realized vol but low implied vol at the same time, like as low as the realized vol itself. That's interesting. So that's our lens is very much to give the market a lot of credit and say it's very smart. It knows how to price volatility. If we throw everything on a chart, you'll actually see that. But there's still some things that lie off the diagonal, and then you can look at those things, and that becomes your candidates. Let's look at these names, and then we can say, and then we can reason about do these names deserve to be off the diagonal? And that's, like I said, where you bring your context to it.
Can you just give a trade example on this? If you have to take a hypothetical trade example, or which you have traded way back on this.
Yeah, absolutely.
Yeah.
So one example that happened, well, some really good examples of it was during you had situations during you had longer dated vols, like 6 to 9 months vols, not like super long dated, but 6 to 9 month vols. They got very expensive around the time that what's the oh my God, I had to close my bank account because of it. The around the time of the First Republic, Silicon Valley Bank.
Okay.
During
Yeah.
this, yeah. I had a First Republic account that I had to, now I have a Chase account, but because I had to roll into that. But
It was in 2022, right? The first bank in it was
what's that?
2022. The Republican Bank thing happened in 2023 early, I guess, right?
23. Yeah.
Yeah, 2023 early January, Feb, I guess.
Yeah, it was around 2 years ago,
Yeah,
like
yeah,
kind of around this time, right? A
yeah,
little,
yeah,
little like later in the spring, I think.
yeah.
And that was an example where you saw high realized vol because of this event, but you also got the long date, even the 6 month to 9 month vols went up a lot. So what the market was, it was interesting because it was like a portrait of uh systematic risk in a way. It's like the market was actually saying saying that this vol was going to last for a long time, this high elevated vol. But that to me looked a lot like that does not happen that often. And a trade that I tend to like there is to basically sell a calendar spread, because you can sell a long dated vol, buy the near dated vol, and then you're just basically wait, like your gamma's covered. You are going to pay a vol premium for it because it's in that situation, the near dated vol is going to be higher than the longer dated vol, because the stress is acute and right now. But if you sell that calendar spread, your gamma's covered. Like you're going to be long gamma, actually. You're going to pay theta. And when the market relaxes, you will if the market relaxes back to sort of normal levels, the amount of money you'll make on the short Vega piece will compensate you for the fact that your front month options are going to erode. But your front month options, they're going to go away. Like, yeah, you're going to get hammered on that stuff, but they are going to go away, and they've protected you in the interim. Another way of saying this is that you are selling a very expensive forward volatility. So your forward volatility between the expiry that you own and the expiry that you're short. So you're like, if you're long let's say it's January and you're long a March option and short a December option, another way of arranging that in your head is that what I'm short is a March December forward.
Yeah.
So as we get closer to March, if the forward declines in value, I will win to that. And sort of that's trades off against like basically the tug of war between your gamma and theta between now and March. But if the vol comes in, you'll win on being short that forward. So this is an example of like, you're looking at the situation saying that is a very expensive forward. And the thing is, you could go hedge it by looking for forwards in other places, that because one thing here is kind of interesting is like, that's a systematic, the market's doing that because it feels like a systematic or structural risk. If the structural risk comes to bear, lots of assets are going to reprice themselves. In other words, like correlations across the marketplace are probably going up. So if there are laggards on that, and there were, you could buy the forwards in those. And then what you have ultimately is like this forward vol spread on, where you're short the forward vol where the stress is acute, and you're long forward vols where it's not. And the idea is that if the entire thing really does become more structural, the ones that you're long have more to gain than the ones that you're short can go up any further. So if it turns out to be structural, you're hedged, and if everything relaxes, you just capture the spread anyway on the basically on the longer dated stuff coming in hard. So that's kind of but it's hard to see that if you don't look at things cross-sectionally. It's kind of hard to see these relationships.
Got it. Thank you so much for this explanation. Uh,
Mhm.
uh, Chris, you spent a lot of time in market making, right? You run your own market making team. You started your career as a market maker. You later run the option book, right, for commodities options. So can you just give an explanation in very simple terms, what is market making for our viewers?
Yes. So market making is uh I call market making is a solution. It's an answer to a problem. So what is the problem? Well, if you go back to I don't know what class they teach about what money is in the first place. But if we go back to or trade, maybe micro 101 or something. If you go back to what is trade in general, we started with barter. And if you're in on an island and there's coconuts and pineapples, well, there's an exchange rate between the two and there's only two goods, and the market's probably pretty liquid. As we get more and more goods, the chance that I want to buy pineapples at the same time that you want to sell milk is probably not going to line up exactly. I think they call this the double coincidence of wants problem. Market makers exist because it is very unlikely that with the number of strikes and the number of expirations that exist in the options market, it is very unlikely that you are going to want to buy a 27 delta put in NVIDIA at the same time that some other natural customer wants to sell that option, with 4 months to expiration. Is very unlikely. So what market makers do is they post bids and offers across all option markets so that which creates liquidity. And they are able to do that because by looking at all the options markets, they are vol traders. They're quoting option contracts, but they are vol traders. And they are looking at the world through this lens of, are these options cheap or expensive? And then they can quote everything. And that essentially creates better prices for customers, because if nobody had this lens of looking at the options from the vol perspective and they just looked at it directionally speaking, then there wouldn't be this other way of parsing the market. Like one of the most interesting things about options trading is that it's called zero sum, and it is at the macro level. You can kind of prove that at the macro level that it is. However, what's interesting about it is if you are bullish on a stock and you buy a call, you might go out there and buy that option, but you might pay too much for the vol. Of course, you might still win because the delta of that contract is very large and swamps all the other aspects of it. So, if you buy a call option, 10% out of the money call, and the stock goes up 12%, but it takes, uh, let's say you pay 1% for the call and the stock goes up, say 14%, but it takes a year for it to do that. You're going to win on your option, right? You'll triple your money. However, the person who sold you that option and then delta hedged it, they'll probably win too. So both the market maker here and you can win. And it's because you were looking at different aspects of this. The market maker was looking at the vol piece. You were looking at the directional piece. I say it's zero sum because who was the loser in this case? It was the person who sold the delta hedges to the market maker. They're like a third party. That's the loser. That's why it's zero sum at the macro view. But in this transaction, both the call buyer, who was directionally motivated, and the call seller, who was volatility motivated, they both won. So the options market is very interesting because you can create liquidity out of the fact that the people that are the end users of the options, they are not really thinking about the volatility. They're thinking directionally. They're just looking at it as a levered way often of trading the stock. So the market makers are able to find this niche where they can have a business, and that business is works because the market needs it. The market needs somebody that is willing to stand there and say, well, I didn't wake up this morning wanting to sell 27 delta puts, but if you're willing to pay 1 vol point more than I think they're worth, then I'll sell them to you, and I can make a business around that. So that is ultimately what a market maker is, and why a market maker exists, why the business exists in the first place.
Kris, as someone who has done market making in, I think in commodities also have done market making.
I've done options market making in commodities,
Yeah,
yes.
yeah, and also in equities, right? So how market making in commodities option is way different, like is different from making market and equities option.
Yeah, it's one of the biggest. So one of the things that jumps out right away, I'll point out the two things that are immediately very, very different. One is in equities, you have the idea of a corporate action. So you have dividends, you have you can have mergers, you can have basically you can have things that can change the share count in a way. And there's no such thing in commodities. A commodity future, because you're trading options, you're trading options on commodity futures. So there's no concept of a dividend in a commodity future. So that's right away one obvious difference. Another difference there is that when you buy a commodity future, you don't have to post the full amount. You post margin, post collateral. So your options model is different because it has a completely it does not need to be concerned with the cost of carry in the same way that a stock option model has to account for the cost of carry between interest and dividends. And then you get to and then I think the really big one, which is where that can really the thing that warps equity traders' minds when they go to the commodity markets is that in the commodity markets, every option contract references a different underlier. So for example, if I trade a December option or a June option on NVIDIA, it's the same underlier, it's NVIDIA, which means that the arbitrage relationships between those contracts have, there's some hard arbitrage relationships there. Like the December option cannot be worth less than the June option. This is impossible. Or it would be free money if that were the case, because the all of the volatility that is encompassed by June is also encompassed by December. So you cannot have a time spread that trades for a credit. In commodities, every option refers to a different underlying future. This is like, I'll use energy as an example. It's a little bit, it can be a little bit different depending on the commodity. Now, that's another thing, is that all the commodity future option specs are different depending on the underlying asset, whereas like in equity, it's all standardized. So for example, if you're trading natural gas options, your January natural gas options refer to the January future. Your June option refers to a June future. And the properties of those underlying futures vary so much so that you can actually have calendar spreads that trade for a credit. You can have, and also because the underlying prices are different. So if, let's just say, you might have more time to expiration on the longer one, but what if that futures contract is 20% higher than the other futures contract? Its straddle is going to inherit that 20% premium in the price. So its price will be, the straddle price will be higher. So sorry, I should reverse it. If the nearer dated was a higher price. So the nearer dated straddle will be very expensive because the price is so high, but it has less time to expiration. So you could end up in a situation where that near dated option actually has more premium in it than the longer dated option. And the other thing is the volatilities do not have to relate at all. The volatility in June natural gas has nothing to do with what the volatility will be in the winter. You have two different seasons, one where we're building gas supply and one where we're drawing down gas supply. There's no relationship between between those periods of time. So that is probably the largest difference in commodity options, that the calendars behave completely different than they do in equities. They're in equities, they're far better behaved.
Yeah. Also, if you can elaborate, like you already took an example to explain like how the pricing of futures affect the straddle prices, right? But if you can just go in a bit detail and explain how, if let's say in one a future contract is in Contango, another was in backwardation, okay, and we want to trade options on those, so how that will affect the pricing of the option, just in between more detail.
Yeah, so if you're well, the one of the main question. So we have an interesting question here about like it comes back to what we think a futures term structure represents.
Yeah.
So you can have one school of thought which thinks that the futures term structure is a predictor of where the future is going to be at some date in the future. And you could have another theory that says, well, I think that the futures, the deferred future is just reflecting the demand to hedge, say 12 months hence. But that future will likely roll down to the current spot price. So in other words, it's not a predictor, it's just the price required to clear the flows to hedge in the back month. So maybe if we take something like, maybe there's a bunch of let's say you're looking at a market like coffee, and there's all this demand to buy coffee in the future because there's concerns about the coffee supply. So there's a lot of demand to buy deferred coffee futures, and that demand is clearing at a higher price than the current spot price. It doesn't necessarily mean that the coffee future in the future is going to be there. So what that has an interesting even this difference in what you believe the futures market is saying has different indications for how you think like a vertical spread should be priced. So for example, if I thought that the 12-month future is going to roll down to the spot price, then I would expect that a put spread on the back month future should be more expensive to buy. In other words, its skew should be flatter. Its put skew should be flatter than a nearer dated future, because I would expect that the longer dated put spreads should be more expensive to buy, because it is more likely than not that future rolls down. It's almost as if there's a drift in that future, and if there's a drift in it, then you should expect that to be reflected in the option surface. So that is one example of why how the options in commodities could vary simply based upon what your belief is about what the futures term structure means.
Got it. Also, now I want to, I will just make few statements. Like these statements are there in the basically in trading circles or all, right? Few controversial takes. So I wanted to know your opinion on those. Okay. So the first one is basically the idea of smart money versus dumb money, the volatility market. Is it real thing or it just a overhyped myth?
Okay, so let me differentiate what I think smart money versus dumb money means. So I think dumb money, and by the way, this is not specific to options, that could be in anything, but dumb money to me means money that is price insensitive. It is a flow that is has to happen, whether because of a calendar, like money that has to go in on the first of the month. That is an price insensitive flow. There's no assessment there as to like, is this the right price to buy this asset or not? It's just we buy on the first of the month. So this is what I would call dumb money. This is when we use the word dumb, we're not referring to the intelligence of the end user here or anything like that. It is just, that is how we can think of dumb money, as something that is price insensitive. Smart money is discerning. Smart money is saying, I think that this is the wrong price. Smart money is intending to profit off of the price that it's trading against. It is not required to put that flow on. It was a choice to take the other side of it. It was like a sharp making a bet. He's making the bet because he sees an opportunity and says, I think this is the wrong price and I want to make a profit, so I'm going to trade against this. Otherwise, I am not forced to trade here, and there's no reason for me to trade. That is broadly my definitions. Now, when you get into the options world, this definition, we can refine it a bit further. So the dumb money definition holds. It's basically somebody that is price insensitive, acting like a sheep. Could be a dumb money example, could be, we used to have this, I remember there was this thing back in like when I first started some 20 some years ago. There was this concept of a recommended line. A recommended line would, so we used to have a research report every morning that came out to all the traders. That it was this, I was at SIG at the time, and the research department would put out a bulletin every morning about various things going on in the world. But one of the sections was about if there was a recommended line. What a recommended line, and this is sort of before Substack and all that thing, it would be these paid investing newsletters that would tell their subscribers, hey, we're bullish on Qualcomm. We recommend buying the May 40 call. And so the research department would like share any recommended line that came out of these things, because on that morning, there would be all of this buying, retail buying, 1 lots and 2 lots and 5 lots, but it would be a flood of it. So I would consider that dumb money. This is just people reading a newsletter and following a herd thing. And, it's not, you don't have to be scared of that order. Now, what is smart money in the options market is it could be really one of two things. Your counterparty knows something. This is why insider trading tends to focus on options, because if you knew something that you're not like, material non-public information, the highest leverage you're going to get is by executing it through the options market, is to take the bet in the options market. But of course, the regulators know this too. So you can actually know something about a stock, and then you go into the options. The options market will sort of reflect it first, because, if you have that information, you want to maximize its value. And that's what crooks do. So, however, so that would be smart money, somebody that knows something. Another example of smart money is somebody that you are trading with that has a vol lens. So in the course of market making, you might see an order and be like, I think that this person wants to do the same thing I want to do, or this person, I think, is selling because this vol is high. In other words, they're not a directional trader. They're thinking about things the same way I'm thinking about. So we would call that a vol smart order. So we would differentiate between a delta smart order. This is somebody that has a pattern of being right directionally speaking, and we would have vol smart orders. A directionally smart order is something kind of useful for a market maker to know, because what they will do is the counterparty might be trading at the wrong vol. But what you could do is, let's say it's a delta smart order and they're buying calls. You could sell them the calls at the expensive vol, and then you could overhedge the calls. You could buy extra shares than you should, more than the delta of the calls, to bet with this counterparty who you think is directionally smart. So we cared a lot about, is a counterparty directionally smart? If a counterparty is vol smart, then they're just giving you information, because you're like, oh, this is a vol smart counterparty and they want to sell options. Now I know that there is a supply of options around these levels. So now what I can do is I can sell options, knowing that my worst case scenario is I can go to them and try to buy options from them because they think it's high. So I can kind of like lean on their order, we would say. So, and then the last way of being smart is that you're just so big that, if somebody has 100,000 options to buy over the next week, you're going to be very sad if you sell them the first 10,000. So they might not be smart in those other senses, but they are so big that you do not want to trade against them, especially, or at least not at the beginning of the order. So we would say like it's smart because it's just so big. That was a kind of SoftBank. I think it was like 2021 when SoftBank was buying all those upside tech calls. It's not that, you know, Masa-san is some genius options trader, but he does have a lot of money. So you don't want to trade against the Masa-san when he first starts buying these calls. So that's another example of being smart, is just having huge size. So yeah, that's you have delta smart, you have vol smart, and then you have dumb or price insensitive.
All right. Another take which I want, like another statement on which I want your take is that on VIX product, right? There are ETFs, ETNs like VXX, UVXY, SVIX, etc. that let people trade volatility indices like VIX. We saw this. We saw with the VXIV ENT in 2018 that these can blow up. These can blow up. Some people say these products are flawed by design and retail traders should avoid trading them. So, what's your view on this?
Yeah, so well, first of all, let's separate traders from investors. If you are an
Yeah.
investor, you almost certainly shouldn't be trading those things because um, they are often they're trading tools, and this is disclosed oftentimes, especially like these levered, like if you have any kind of levered product, that's especially true for them. The And also the nature of the products is short term. You're trading an ETF that holds a 1 month future. It is by definition short. Yes, it does roll. It is constantly rolling. But at this point, if people don't understand negative roll returns and that cost over time of that, I mean, this has been harped on and it's all disclosed, and at this point, it's just willful ignorance. I would say that if you don't understand these things, then you really should not be trading them at all. So I would say, first of all, they're not great investor tools, but as trading tools, for the most part, they do what they say they're going to do. Now, I think the problem you get with these products is that like any tool, you can misuse it. I mean, you can drive over people with your car, right? So it's any tool you can misuse it. The problem is that in service of marketing and distribution, we dumb things down, right? So there is an incentive to dumb things down because that's how you sell. So, but that said, you know, this gets into sort of like, how much nanny state you want to be about these things. I mean, do we not want to create useful tools because there's somebody that is going to do something stupid with it? I don't think you can kind of run things that way. So you end up, it also, this kind of makes me think of there was this comedian here, Dennis Leary here in the States that was very popular sort of like the 80s and 90s. And like, he's got this old joke about if you made the warning label on cigarettes, the entire box, and you put a skull and crossbones and you called them tumors, like the smokers would be lined up around the block to get their hands on these things. Like at the end of
Yeah.
the day, you can put whatever warning labels you want. There's already so much compliance in TradFi. There's so much regulation, and yet you see people doing insane things in DeFi. If you want to do crazy things, no one's going to stop you. There is always a way to do crazy things. So my view on the VIX tools is if you use them in the surgical way that they are designed, it's fine. It's another choice. Investors should probably stay away from them. And if you're an investor, you're probably not looking at things. You don't want to be that short-term oriented anyway. I mean, once you start adding up like the tax liability with these things and short-term trading, and unless you're going to like form a business around trading, you probably do want to avoid these things. Like in the long run, they end up being expensive behaviorally.
Got it. Now the third take, which I want you like which on the third statement on which I want your view. So basically, after post-COVID, I guess there's been a huge surge of option gurus on YouTube, on social media. We see a lot of option traders putting this trading screenshots or telling people strategies, right? So claiming high returns, win rate. Okay, if specifically in India, we had just seen a huge rise. Like you can't even see like people have made so much money from social media just by talking about options and selling courses option, even if they haven't made money trading options. So what do you want to say on this?
Okay. So this is, uh, you know, this stuff always exists. There's real estate infomercial seminars. There's, you can be a house flipper too. That was all the rage in like going up to 2007, 2008, and at
Oh
least in the
yeah,
United States, right? Um, there's always money to be made selling a dream. Okay. So what they're doing here, it's the trick that they're doing is they are treating options, they're using the idea that options decay and the idea that many options expire worthless. And they are, instead of orienting the discussion towards value, what's the value of this thing? It's just perpetual money machine nonsense. Like if I sell this, I have found a magic cheat code. Like somehow they've found the magic cheat code, despite the fact that there's incredibly well-paid, well-resourced investment managers trying to eke out, a little bit of outperformance. It's like somehow eluded these people, and you can have this opportunity. It's completely on its surface insane. So what I want to do, though, I think a useful thing here is to kind of demonstrate the maneuver. What they're doing is they're playing with framing. It's this, hey, if the stock goes up, you're happy anyway. Because you're short a call and the stock goes up and your stock gets called away, you're happy anyway. And if the stock
you
goes
just get
down,
the theta. You just get the theta.
exactly.
Yeah,
And
yeah, that's what they
if
sell.
the stock goes down, well, they're kind of ignoring the fact that like if the stock doubles, you have like way underperformed the counterfactual, right?
Yeah,
And then if the stock goes down, you make more money because at least you
yeah,
collected some premium. The problem with this framing is they're making a very dishonest comparison here. If I buy a stock and I sell, let's pretend I buy the stock, I have this investment, and then I sell a 25 delta call on it every quarter. So I buy the stock, I sell the call. In 3 months' time, I sell the next 3-month call, and I do this 4 times a year, right? To harvest income, as they say. Well, the comparison to this, the proper comparison is if I buy a stock and I sell a 25 delta call, my delta is no longer 100. My delta is
yeah,
75.75, right?
yeah,
So the right comparison is to say, let's look at two portfolios. One where I engage this income strategy of buying the stock and selling the call, and another one where instead I just own 75% of the amount of stock that I started with instead. And if you look at that, if you were to just imagine a price axis, in the case where the stock doubles, you would do better off owning 75% position rather than having long stock that has the entire position taken away from you when you're up when you're up 5-10%. Also, you do better if the stock goes to zero, if you were just long 75 shares, because here you collected a small amount of premium, but you wrote 100 shares to zero. So once you realize that, it becomes very clear, oh, I'm just short vol. So I do worse when the stock doubles. I do worse when the stock craters. So where do I win? I win if the stock stays, let's say, somewhere within one standard deviation. That's where I do better with the covered call scenario. Now, is that a desirable payoff or not? that's up to you. I have no bones to pick with somebody that says I prefer that payout. The problem is that's not how this is framed. It's not presented that way. So you're not actually evaluating whether I prefer this payoff to that payoff. They're just saying this is free money and you're going to be happier if you just do this. And that's just making a bad comparison. So that's the other thing is, if you told people the reality of what they were doing, that you're going to win if the stock stays, say, within one standard deviation, that's the same pitch you would make if you told people go sell straddles. And
Yeah.
yet you wouldn't go tell people go sell straddles because that doesn't sell. People would say that sounds crazy. But what are you doing here? I can algebraically prove to you that you are selling an in the money straddle when you sell a covered call. Like there is no that I can prove that. So that's so what they're doing is they're just, like I said, they're just playing with framing. They don't want to tell you to go sell straddles or go sell in the money straddles or sell in the money puts. They tell you go buy the stock and sell a call and it's free money. It's just they're just playing games.
I think another thing which I observed is in India, what happened is after 2020 crash, we had a VIX went 80. Okay. And after that, the premiums were so high, everybody who was selling option was getting a lot of, you can say, the world started coming down from 80. So people, the options are highly overpriced. So a lot of people made money and thought it's a holy grail to make money, at least for 1.5 year. From 2020 March to, you can say, 2020, 2021 and then 2020 second starting. That was the time a lot of people came into option selling, sold options, and most of the strike you used to sold used to go to zero because again your curve is again down. So a lot of people were making money, and because of that, I think a lot of people got lured in from 2022, 2023, and started thinking like, okay, it's a holy grail. You just sell option, you make money.
Yeah, I think what you're saying there is exactly right in that. So there was a chart going around on Twitter
Yeah,
showing there was a chart on Twitter that was showing this is going back to the 90s that showed a comparison of owning sort of like owning a passive index versus overwriting the index and selling the index. And if you look at the chart, the compounded return over, 25 years or whatever it was that if you sell the calls that was a better trade. Like you made more money doing that. The problem was so the chart wasn't a log chart.
okay.
So
So
what
it
it
was a
did
thematic
was
chart.
it masked the fact that all the gains, all the outperformance happened basically going up to like say 2010, right?
Yeah,
Since for the last decade,
yeah,
it's been worse to do this. So the story here is there was this volatility risk premium that got very well advertised and the academics kind of talked about it,
yeah,
and this premium became sort of common knowledge. So, I would say like markets are not physics problems. It's not gravity. They're biology. It's like if everybody learns about something, then they do that and they change the price for it. So
yeah,
this volatility risk premium was very persistent, sort of like say in the 90s and even in the early 2000s. But once everybody gets wind of it, and then all the large asset managers start selling options, that completely changes the shape of the supply demand for options. So you get the situation now where there is so much options for sale on the basis of this, basically a back test,
yeah,
and the proposition is much more fair. It's much more of a coin flip where it's like it's not clear at all that just naively doing this is a good idea. And even if it makes a little bit of money, it's making a little bit when it used to make a lot more, and it's not clear that it's the bet like a good risk reward necessarily. So my guess on this is that this VRP idea is that and it would not be surprising that during a stressful period that clears out a lot of option sellers, that wipes people out, that the strategy would once again become profitable. It's just if you reduce the supply of options, then the clearing price for options goes up. and now there's a little bit more meat on the bone, and so there's an opportunity there until everybody gets used to this again, and then the supply comes back and then squeezes out the opportunity. I mean, it's like a market, like any market. It's just the way the labor market works, the way the market for goods and services work. It's just a marketplace, and there's a lot of supply. The supply gets wiped out, the price goes up, there's a risk premium to selling again, and then it gets overdone and comes back down. It's a completely cyclical thing.
Yeah, we had a similar situation in India. So after 2023, the wall basically never went above 9 and 10. The VIX index of India, the VIX, we call it India VIX, it never went above 9 and 10. And even I faced initially was first quarter or like a lot of problem in like basing. I was negative the first quarter to understand and change my strategy during that time. And the whole year was like that. Simple reason, everybody thought you can make insane money selling options. Everybody started selling options. The premium never went, like the VIX never went up, and the premium were never there to sell. And I still remember I was studying this data in 2024 again. I took the last 1 year data of 2023 and studied. Hardly I can count on fingers. 3 days were 4 days were there where are one of the most traded index, Bank Nifty, and trade went above, like moved more than one or like two more than 2% in a day. And that was the situation. So the whole 2023 was like there's no, like you don't have wall to sell, and people are still selling it because people don't understand that you need something to sell. You without having, you, how can you sell it?
Yeah, I think what's funny about this is like the lack, it's the problem, a lot of the problem goes back to this sort of like a lack of appreciation for the fact that markets and trading are adversarial by nature. So in other words, it's a lot more like poker than it's poker. It's not like I'm trying to throw a ball into a hoop and there's nobody guarding me, and I just, how many times can I get the ball in the hoop? It's like your opposition reacts to you. They adapt. So this situation, let's say, well, if everybody knows that the vol never goes above 10, and then somebody says, I'll show you a 10.2 bid,
Yeah,
how do you update your beliefs? Does this person that's showing a 10.2 bid not know that the vol never goes above 10? Why are they bidding? Like all of this is actually interesting stuff, because it's funny because we talk about in the investing world, people get very they get caught up in a lot of complex math, and they like the sciencey part of it a lot. But when I think about my training, almost all of it was focused on this adversarial property of the market, that somebody wants to, it's like if somebody wants to play 3-card Monte with you, you're not going to play 3-card Monte with this person. So it's the same thing. It's like what's the probability that you have edge conditional on the fact that somebody bid you that price in the first place? That's the real relevant question here. Not we can't look at unconditioned probability distributions. We're like, oh, this thing has never went above 10, so every time it gets to 10, I'm going to sell it. It's like, given that it's 10 bid, what do you want to do? And that's a much harder problem. So that is it's this like treating the market. This is like what I say with the perpetual money machine thing. It's like treating the market as something that just spits out dollar bills or rupees. It's just not it's just flat out silly.
yeah. So I just have one more, like I just have another question related to AI. So everybody's talking about AI. Like we are seeing a lot of content, like a lot of talk around like AI mod, like AI agents and everything. So do you think we will see any like any use of AI in when it comes to options trading or in vol trading, like in any manner? So
I would guess that it is very much in use right now.
okay,
So I'll speak broadly about it. I think people, when they think of this question, they have this ideal fantasy in their mind where they're going to create a robot is going to basically just turn on and make you a bunch of money all the time. And this fantasy falls out of the fact that, again, it's just ignoring the adversarial nature of markets. It's like you have AIs, you have AIs that are trained on data, and then what happens is the AIs create their own data by trading. And then that data becomes part of the marketplace. And so you kind of have this circular problem where it's like, are you trading based upon what the other AIs are saying, how the prices should sort of go? Like, in other words, like there's no solving the market. There's no idea, there's no notion of like you're going to solve the market. And I think that sometimes people think of this AI stuff as, oh, AI will solve the market and put all the prices in the right, and all the prices will be correct. I don't think that's really the promise of AI. I think the promise of AI is, and this is, when I say this, I'm going to be speaking sort of like in terms of what's visible to me. I mean, AI might, maybe we're all going to be gone because of AI. I have, it's but like in the near term, uh, I think of AI as it raises productivity. It's doing the same thing it's doing everywhere else. It's a multi-purpose technology that raises productivity across the board. You can do more with less people. You can, and I think all of that is going to mean that you can do more, you can do better analysis. You are going to be able to, or faster analysis. You're just going to do everything that you were going to be doing anyway. You are going to do it faster and possibly more capably. In other words, it's just improving all the process. So I think it's a process accelerant. I don't think it changes the fact that everybody's going to have their own AI. Everybody's armed. So it will not be, and maybe there's a period of time, there's like sort of a Goldilocks period where the early adopters are able to find more edge early. I mean, this wouldn't surprise me if we look at Jane Street's profits. They made Jane Street made $14 billion last year. On a per employee basis, they're one of the most profitable companies on the planet.
Yeah.
It sure seems to me like they found some cheat codes. Is that how much that advantage is durable? On a 10-year time horizon, I have no idea, but my guess is that you have companies that are very smart and very well resourced that are able to enjoy this Goldilocks period where they are well ahead of the curve. Now, I do think if all the processes are getting better and people are becoming smarter at pricing, it may not mean that there's going to be these outsized profits for everybody. And that's actually just a reflection of the fact that the market will become more efficient because of that. The whole idea is like the market has been getting efficient, gets much, much smarter all the time. I know people like to say, like, look at the price of these crazy meme coins or something. That's a proof that the market is not efficient. I urge you to sit in a trading seat and tell me that the market doesn't feel very smart to you. Like when as an options trader, I can tell you it's not easy to outsmart the options market all the time. The market does a very good job of setting point spreads, like I said before, especially liquid markets. So if it were easy, you would see way more profitability from sort of like investment managers that are focused on options. They would look obviously way better than all the other kinds of investments, but they don't. The people who do look a lot better are the prop shops. But that's not, they have advantages in place that sort of like investment managers don't. They're closer to the exchanges. They are market makers. It's a different business than an end user using options. So even if the end user is smart about volatility trading. So the overall, I think that the AI stuff makes processes more efficient and better, probably makes the market overall more efficient, more difficult. There'll be, but I don't think the problem is like the skill level. If ever the skill level of everybody goes up, then that doesn't mean you make more money.
But also now I will have just series of technical questions.
Yeah.
Okay. So let's start. So the first question is basically from your newsletter, which I basically read, your Substack. So in one of your Substack letters, you discussed about gamma scalping. So if you can just give a brief overview of what is gamma scalping and how it works basically.
Yeah. The best way to do this is to just do a demonstration. And that is we can just imagine let's say you buy in a US stock, so 100 multiplier underlying. You say you buy 100 at the money calls. So let's say the stock is $50. You buy 100 of the 50 calls. And the delta of those calls is 50.5, meaning that if the stock goes up $1, that option goes up by 50 cents in value. Now we know a deep in the money option is 100 delta. So there's some glide path by which the stock is traveling from 50 delta to 100 delta as the stock goes higher. If the stock was $100, that would be a 100 delta call. It would act just like the stock. So let's say that the stock goes up $1 and the delta of that option goes from 0.5, let me just say from 0.5 to 0.6. So what happened is you started delta neutral. You were long 100 calls and you were short 5,000 shares of the stock. You have no, you're market neutral, delta neutral. When the stock, by the time the stock is finished making its move, you are now long 160 delta calls and you're still short 5,000 shares. So your net delta is 1,000 deltas. You're long 6,000 deltas in the calls, the equivalent of 6,000 shares, and you're short 5,000 shares. So you are now long 1,000 shares equivalent of stock. Meaning that if you're long 1,000 shares equivalent, that means if the stock goes up $1, you make $1 times 1,000, you make $1,000. And if the stock goes down $1, you would lose $1,000. You are not trying to have a directional opinion on the stock. You are trying to be market neutral. So what happens is you will go out and you will sell your 1,000 shares and reestablish a delta neutral position. What will happen is you are now long 6,000 deltas through the calls, 160 delta calls, and you are now short 6,000 shares of the stock. So you are once again, you are delta neutral. Now, if you imagine this, if the stock goes up again, you'll sell it again. You'll have to sell, you'll have more shares to sell. So your delta will increase. If the stock falls back to 50, you will now be, you'll be short 6,000 shares and your calls will go back to being 50 delta. So you will now be long the equivalent of 5,000 shares. So you get to buy your 1,000 shares back to establish being delta neutral once again. So you have here we say you've scalped 1,000 shares, $1. So you've made $1 of profit because you were trying to stay market neutral. That's what, so the fact that your delta increased as the stock went up, that was gamma. So gamma is the change in delta per change in stock. And by continuously rebalancing to be delta neutral, this is what people call that, they call it gamma scalping. By rebalancing and essentially you're hedging, you are going back to market neutral. And in that process, you are, if you are long options, you are always selling high and buying low. And you end up with this profit. Of course, the profit is offset by the fact that the options decay. You have theta. So you have a push and pull here where you, every time the stock moves, you're able to make some money. And if the stock stays still, you just decay. Well, you're decaying either way. It's just how much money are you going to make scalping the gamma. Now, that is, that's what gamma scalping is. And the reason people gamma scalp is people think it's because that's how you make money, but it's actually not true. It's a bit of a confusion. That's actually not the true reality, because if you never got gamma scalped, it does not mean that you would not make money being long the options. It just means that, because when you gamma scalp, like take this example, if the stock had went up $2 and you sold 1,000 shares up $1, it's true that you gamma, like you would have been better off to never have sold 1,000 shares, to basically never have gamma scalped. In other words, if you just let your delta ride, your gamma ride, you would have made more money. What gamma scalping does is it doesn't monetize, or it's not you probably don't want to think about it that way. What it's doing is it's just hedging. You are reducing your risk, because remember, you're a market neutral player. So you don't want to have outsized directional positions. So you're trying to minimize them. So regardless of whether you gamma scalp or not, that's not any kind of source of profit. What that is, all it's doing is it's changing the shape of your P&L. It is reducing your P&L variance. If you had an infinite bankroll, you could just not gamma scalp. And if you were buying options low and selling options expensive, you would make money over time, whether or not you ever hedged a single share. It would still work. You would just make all your money on these really large moves. So what's happening here is that you are, by gamma scalping, the thing you are doing is I am reducing my P&L variance, and I'm paying a cost to do that in the form of transaction costs and slippage. So I am accepting a known cost to reduce my P&L variance. Whether I gamma scalp or not has no bearing on whether what I'm doing is actually profitable or not. It just changes the shape. I think this is, I'm making a point of this because I think this is like deeply misunderstood by people, that they think that the scalping is the source of the profits. It's not the source of the profits. It is just reducing your P&L variance so that you can actually survive.
So can you just give what does a P&L decomposition look like for gamma scalping? If I have to
What
decompose a P&L?
so the decomposition of the
Yeah,
P&L?
yeah, yeah.
Yeah. So well, so gamma itself is a source of P&L attribution. I mean, I don't think it's necessary to decompose the gamma P&L further. And by the way, I will just say that the gamma P&L, it's kind of a neat formula, because it is, the formula for gamma P&L is if you square the stock move, multiply that by how much gamma you have, and divide that whole quantity by 2, that's actually your gamma P&L estimate.
Okay.
Where does that number come from? It's actually just acceleration in physics. It's because
Yeah,
what it's saying is, what is my average delta over the move times the move? I mean, this is
yeah.
really what the gamma P&L is. So gamma P&L is its own source of P&L. Options P&L can be decomposed into your realized volatility P&L. Your realized volatility P&L on an option is the push and pull between your gamma scalping or your gamma P&L and your theta P&L. So your gamma, if you're long an option, your gamma P&L is always a positive number. It's always this 1/2 times gamma times stock price squared, change in stock price squared. That's always a positive number. Your theta P&L is always a negative number. Okay, so the sum of your gamma and theta, that makes up realized volatility P&L. Your implied volatility P&L is how much did the implied vol on the strike change times the vega of the option, or the sensitivity of the option to volatility. So you can think of all options P&L as having a realized volatility component, an implied volatility component, and because what we're doing here is, and we're assuming here that you're running a delta neutral position, that the idea is here we're trying to isolate vol P&L into these two components, because again, we're not fancying ourselves directional traders. We're not trying to make money from being long or short or having an opinion on that. We are just saying, I'm a volatility trader. How am I doing on my volatility trading? Am I winning or losing to my volatility trading? And this is how you find out.
Building on the vol trading stuff. So can you just tell how do you incorporate volatility skew or smile in your trading decisions when you do vol trading?
Yeah, absolutely. So the main thing here is we'll go back to Black-Scholes for a moment.
Yeah,
So Black-Scholes assumes that vols are constant,
yeah,
but just empirically, we observe in the marketplace. We just take something like a broad equity index. there's an inverse relationship between volatility and the spot price. So as stocks go up, volatility tends to decline. And when stocks go down, implied volatility tends to increase. Realized volatility also follows the same property. It does tend to decline as the implied vol as the market rises, and it tends to increase as the market falls. So what happens here, again, we'll go back to the at the money call because it's very demonstrative. So if I'm long 100 50 delta calls, at the money calls, and let's say that they're 50 delta, but I know that if the market goes up $1, the implied vol is going to fall. Now remember, delta is just supposed to be a hedge ratio. It's just it answers the question of how many shares do I need to be short against this call so that my P&L is unchanged in various local scenarios. That's really the question delta tries to answer.
Yeah.
And if I know that volatility is going to fall as the market goes up, my prior example of the market goes up $1, so I make, $5,000 on my calls and I lose $5,000 on my stock, so I'm market neutral. But now I'm telling you, no, implied vol is going to decline when the stock goes up. So let's say that the implied vol is going to decline by 1 point, and the vega of these options is a dime. So what that's saying is, and let's say that the market drops $1, I expect volatility to increase by 1 point. So now when the market goes up $1, I actually lose $1,000 because my options would have made 5,000, but because vol fell, I lose $1,000. And of course, I still rode the short 5,000 shares up $1. So I net lose $1,000. So what I need to do is I need to lean long. I need to lean long shares so that when the market goes up, I actually experience a zero P&L. So I actually need to be long an extra 1,000 shares. I need to treat this option as if it's a 60 delta. So if I'm 40 as a 40 delta. So I don't want to be short 5,000 shares. I want to be short 4,000 shares only. So I'm going to treat it as a 40 delta. Likewise, if the market goes down and the vol goes up, I will also be hedged in that scenario. So what happens is your assumptions, which now are varying very much from Black-Scholes, which thinks that vol is constant, your assumptions say vol moves with the underlying. Therefore, all my deltas are now different. So skew is some part of understanding the dynamic. The skew is kind of telling us something about how vol behaves on various moves. And if you take the knowledge in the skew, you can incorporate it into your deltas. Like, for example, locally, you can say, I think that the market vol goes up and down by the slope of the skew through the at the money point. So you can take that and then say, apply that assumption to my deltas. And it will change. It will actually change all your deltas of your options by a little bit. And which is not that significant. If you're a retail trader, this is honestly not that important because changing, if you got 1,000 shares of stock and the delta changes by, 5 deltas, you're talking about a 50 share change. It's not that significant. When you're running a large, complex options book, like a big options portfolio, all of this stuff really starts to add up. And so, and again, you're trying to isolate your trading and minimize noise. So the idea is like you want your hedge ratios to be as accurate as possible. That's one of the main things about sort of modeling options, is that it's trying to understand the assumptions of like how the surface behaves as the market moves around. Do the strike vols tend to stay constant? Do we tend to move along the skew, or does the entire skew curve shift up and down? So this is where you get these words like floating skew and sticky strike skew and all these things. And all of this is an attempt to say, how does the vol unfold as the market moves around? Because all of that affects my hedge ratios. And There's not one. How that works can vary by asset, can vary by flows, can vary by regime. Like in the same, an asset can go from sort of a floating vol to a sticky strike vol, can spend 6 months in one regime and then 6 months in another, because at the end of the day, option surfaces are driven by the supply and demand of options, which is driven by flows, and flows change. Things become in vogue, things fall out of vogue, products become popular, products lose popularity. So there's nothing monolithically always true about skews. It's a very dynamic problem.
Or next question which I have is on volume risk premium. How do you measure this premium in your strategy, and what ways do you trade on the difference between implied and realized vol?
Yeah, so this kind of goes back to the beginning a little bit, where the first thing, just to answer the question how we measure it, we do a simple percentage premium or discount to the
Okay,
to the um to the realized. Now, of course, well, I want to point out two major potential failure modes of a VRP measurement, because what we're doing is we're saying, what's the implied vol, which is a forward-looking measure,
sure.
divided by the realized vol, and we're just
Yeah.
computing the premium. But the realized vol, of course, is a backwards looking measure. So we can imagine there are two major failure modes here. One is the failure where a known event is in the future. So earnings is coming up. The implied vol is aware of the earnings coming up. The realized vol is backwards looking and has not experienced earnings. So your implied vol, so your VRP is going to look very rich. It's going to, as the implied vol increases. But of course, it's because the implied vol knows something about the future that the realized vol stream does not know. So that's one failure mode. You don't want to be, this is like a very obvious one, and you don't want to be naive about a VRP when there's like a known event in the future. The other failure mode is the opposite failure mode, where the implied vol is well below the realized vol. And that's because an event is in the rear view mirror that is not expected to recur. So if you consider what VRPs look like after earnings, they're always going to look very, very cheap. Like options are going to look very cheap because the stock moved 10% on earnings and now the vol's 30 again. But that is also expected. It's because the market knows there's no earnings event coming up. So those are the two major failure modes if you look at a forward-looking measure over a trailing measure. Now, so the solution here is that you have to normalize for this. You have to adjust. So this is where you get the idea of, if you have a known event in the future, you try to separate or extract the event from the surface. So you say, okay, what would my baseline implied vol be if I assume that the straddle on that event day is 6% of the spot price? The market expects the market to move 6% on that one day. If I extract the variance associated with a 6% move on that day, I am then left with a residual amount of variance that can then be divided amongst the other days. That will tell me what the baseline vol is. So this is the right number to compare to a trailing measure. It's like you're comparing two things that are apples to apples. So that's the solution on the forward basis. On the backwards basis, it's actually a bit of a harder problem, because you can, how much, if you want it, let's say you wanted to extract how much of the realized volatility is coming from earnings, you get into these questions of, well, was the earnings move the entire day? Just what happened on that day? Was there a post-earnings drift that I really should have incorporated into the volatility there? But the point is just to actually be aware of it, and that to make sure you're not comparing apples with oranges. So if you've done all this, then it just goes back to what I've talked about before, which is you can look cross-sectionally and say, how are liquid markets pricing implied volatility relative to realized volatility. One thing I'll kind of mention, this is just for one thing that I had tinkered with. So that's a cross-sectional view, but one thing that I had actually tinkered with for a bit was not a cross-sectional idea, but a very much a time series sort of idea where I would say, let me look at a 1 month implied vol and say, we know that a 1 month implied vol gives some weight to the recent realized vol. It also gives some weight to mean reversion, to the idea that, like, again, like if the recent realized vol in the S&P is 6 and the implied vol is 9, it's clearly not weighting the recent realized vol. It's not giving it 100% weight. Otherwise, the implied vol wouldn't be 9. So one thing you could do is say, okay, this is where you get like people will use things where they exponentially weight the realized vol to say, let's give it different weights. One of the things that I had tinkered with was actually discrete buckets. So to say, what if I modeled my 1 month implied vol as a function of what the 5-day vol is as a bucket, the day 6 to 10, like 6 days ago to 10 days ago, 11 to 20, and you created different buckets, and then you kind of like regressed those buckets to kind of come up with a model vol to be like and then over time you can kind of look and say, oh, the market right now seems to be giving extra weight to the most recent realized vol, or before it's like it's kind of discounting the recent realized vol and seems to be giving a lot of weight to the way vol was typically behaving in the back. All of this is like another way of sort of like trying to compare implied vol to realized vol. And then even with the realized vol, you can get into, there are many ways of calculating realized vol. You can sample multiple times a day. You can sample highs, lows, all these kinds of things. So the whole idea, I mean, it's essentially the very fertile area of research that's always been kind of true. That's always happened for option trading. But I would say that all of that intelligence bubbles up into what the implied vol actually is. This is, the implied vol is the point spread. And so presumably all of this innovation is somehow in that price. So the question is can you actually beat the implied vol estimate on the forward realized vol? And that's, of course, people get paid a lot of money trying to figure that out.
So another question which I have is basically from your again Substack, which I had read. So in your Substack, Moontower, you cover like interpretation of implied volatility surface. So how do you analyze the change in vol surface, and what specific signal do you look for that indicates a trading opportunity? So how do you figure out a trade? How do you figure out a trading opportunity from a vol surface?
Yeah. So, well, the first thing we do is like we don't actually, so we don't compute our own fair values.
Okay.
Actually, as market makers often do.
Yeah.
Market makers will have like their own, what they call their own Theo.
Yeah.
Actually, the last time I ever had my own Theo for um for options was probably 2011, 2012. I basically traded without Theos for the next decade. However, it's not that I had an idea, I had an opinion of what I thought was roughly fair for options, as far as like, I think that these vols are sales, these vols are buys, and by how much. Like, I think that there's this many vol points of edge. I didn't necessarily have, but I didn't have like a single number. That market makers tend to have like a single number, like this option's worth 676 right now.
Yeah.
So what we do is more of like, our lens helps you to construct your axes. What options, what names and what parts of the surface are relative buys and sells. And then what we do is we can have something in practice, what you do from there is then you say, I have my shopping list. I know what I like as a sale and I like what as a buy. Now let's go and see what the flows are doing. And what we can do is see how much are the vols up or down on the surface in the areas that we're interested in. So like you might say, I'm a buyer of near dated downside in XYZ. And then you go and you see XYZ's near date. If you look at a heat map, we do this in there, we call it the scanner. You can look at how the vols are changing across the surface in all the names. So you can imagine a grid on the top where you have all the expirations, and on the left you have all the names. And then you can say, oh, look, the vols are up. Overall, vols look like they're up a point. This name, the near-term downside is unchanged or underperforming the market. So that might be a good day for me to go out there and buy it because I thought it was cheap and it seems to be offered today. I don't know the exact flow. That's like you can like pull up an option montage and kind of look at the volume and the open interest and kind of see like, okay, the vols on these strikes actually are down today, and it seems like there's some volume there. So presumably there's a seller, and so it's a good day for me to be buying these options, which I think are cheap. So that's which is exactly how my professional trading looked. It's like I would have my axes, I call them axes, your opinions, and then your execution would be based upon let me buy the stuff that's down today, sell the stuff that's up today that I think is expensive and that I think is cheap. If it's ambiguous, like I think something is cheap and it's up today, that might not be a day where I'm buying it. It might even be a day where I might say, I'm going to sell some of it because maybe I bought it yesterday when it was down and today it's up. And, yesterday I bought 50,000 Vega and today maybe I let 10,000 Vega go. So you're sort of playing like market maker in the context of having an axed opinion about the world. And which is nowadays, unless you're a high frequency trader, pretty much even like, I know people think like of market makers like they're all trying to like balance flow, but the truth is they have opinions. They know what they think is cheap and what they think is expensive. The markets are way too efficient for you to be able to trade thinking I'm just going to be on the bid and on the offer and flip all day long. I mean, the technology requirements for that are incredibly expensive. So unless you have a giant CapEx budget, there's not a reasonable way to trade. You have to have an opinion. You have to be willing to warehouse risk.
Also, what is your take on generating delta 1 signal for wall skews? So have you ever like studied like generating a delta 1 signal from wall skew? So let's say if I take a stock, right? And if I study its skew, and can I generate a delta 1 signal, like should I long this stock or should I short the stock?
I wouldn't say that because I never tried to build directional strategies.
Okay.
I am aware, I was very close to a strategy that, where I worked, we had a lot of different kinds of strategies, but there were strategies that did try to incorporate, like for example, what the call skew was doing
Yeah.
in terms of, it was in the context of like a CTA. So you could have like a trend following strategy, but the signal had an additional filter that revolved around what the call skew is doing. But I would say this, I think there's a bit of an asymmetry in, I think you can probably learn a lot more about what you shouldn't do based upon the skew. Like it's a better as a negative signal than a positive signal. So I'll just say that I think that there were signals that saved us money more so than allowed you. They were more defensive than offensive. So they wouldn't necessarily say you should do this trade, but they might say, actually, you probably want to put the brakes on because of this particular thing. And those was like basically informed from the options market. I can actually, but I can give you a little bit more than just saying, no, I don't create delta signals out of options. One of the things that's really fantastic about options is that they can provide opportunities because they are basically forced into this weird box. They are asked to reconcile two conflicting things. I'm going to give you an example with skew. If put skew in the market increases, the demand for puts increases.
Yeah.
Relative to the at the money, for example, that is mechanically reducing the price of a put spread.
Yeah.
So you're getting this competing thing where the put skew increasing is saying the left tail of the distribution is longer than we thought it was yesterday. That's what put skew increasing is sort of saying. Now, assuming the stock is in the same place, that increased probability to the left of that strike must be coming from somewhere else. So where it will be coming from if that put spread gets cheaper is it's coming from the area of the strike itself. It's coming from the area saying that, let's say that it's the 20% out of the money put. The market is saying we can actually, yesterday it was saying the market could only drop 40%. Now it's saying the market could drop 50%. But that additional probability had to come from somewhere else in the distribution. So where it comes from in this case, in the example I'm giving at least, is that it says that it's less likely that the stock goes down 10 to 20%. So if somebody is buying puts because they're bearish on that long left tail, another person who is also bearish can take advantage of that and say, you know what, I'm bearish. I'm not in it to play for down 50, but I would love to hedge my portfolio on a down 20. So, and I'm getting better odds on the down 20 because this person's buying the puts. So what's really interesting is like somebody is expressing a bearish trade and they're providing a better price for a different bearish trade to this other investor. And this also manifests in all kinds of crazy ways. Like if you think about a ratio put spread, if somebody bids the heck out of that 20% out of the money put, they might make the price of the, say, down 10%, down 20%, 1x2 put spread really cheap. If you're a directional trader you might look at that and be like, wow, I can pay maybe 1% for that structure. And I don't start losing until the market's, down. I'm making numbers up, so it's kind of a little wild. Like I don't start losing until the market's down 30. So I can pay 1% and I don't start losing the market's down 30. I like that payoff diagram, and you can choose to do that. Now, as an investor, you could do that, but maybe the market makers are buying those 20% puts. And in their mind, they're not thinking about this in terminal distribution space. They're not thinking about this in terms of like, I'm going to hold this trade forever and then realize this payoff diagram. They're thinking dynamically. What they're thinking is, I'm happy to buy these 80% puts because if the market drops 5%, I think the vol is going to explode on these things and they're going to act super convex. And I'm going to own all this extra Vega on the market down 5. And so this is, I'm thinking about this pathwise. I'm going to make a lot of money owning these things, not because I want to hold them to expiry, but because I'm going to get to use them to trade. So the different perspectives people bring to the market create different opportunities for the same exact thing happening on the surface. And that's really what I think is beautiful about options.
Oh, yeah. I had one more question for you. On basically it's on Greeks. So we know about Vanna and Vulga, right? For advanced option volatility strategies. So how important are these parameters, basically Vanna and Vulga, and how do you integrate these into a risk management process?
Yeah, so here I'll just here's a fun nugget. I have never looked at the Vanna or Volga of an option on my book. I've never looked at that number. What, like how much Vega, Vanna or Volga is for a particular option. I mean, I've seen it in like sort of like internal things or like other people kind of like looked at that stuff. I never cared about it. What I care about is, how does this portfolio of options operate when the market gets shocked in stock and vol and spot and vol? So what I would do is, if the market is down X% and I have assumptions about what vol does, I have some some canned dynamic of what vol does, different scenarios. And then I can start to see what's my range of P&L if the market suddenly opens down 10% and vol does this, what happens to my book? Now, all of those second order Greeks, they're captured in that estimate, right? It's like I
Yeah.
haven't specifically assigned the P&L due to those Greeks in it, but what I care about is how does my book behave in that scenario? I don't really care about the attribution there because it's not a mystery to me why that P&L ends up looking like that. I can look at my book and say, oh, well, I can look at the shocks and say, well, it's pretty clear that I'm short a bunch of out of like down 10% puts and I'm long twice as many down 25% puts. So I can see that what my Greeks look like on these various shocks. I can look at my open interest at my inventory and say, I understand where it's coming from. So if I want to, shape the clay and say, like, I would like to move some of my risk from this part of the distribution to this part of the distribution. Oh, I need to go out. Okay, so today I need to go out and buy 500 oil put spreads so that I can move. I need to buy some of the shorts in the down 10, and I need to sell some of the long puts in the down 20. So I need to buy that put spread to kind of shape my risk a little bit better. Okay, so in no part of that did I think about Vanna and Vulga there directly as like actual sensitivities, but they are implicitly understood in this entire framework of trading. And this is so for example, I would say most of my career probably was long Vulga, but I never explicitly looked at how much Vulga I was long. It's just that I would tend to run books that got much longer vol when vol was shocked higher or the market moved a lot. So if you sell like the classic sort of like you can think of a Vega neutral butterfly, you sell the at the money straddle, you buy 1.4 25 delta strangles. That ratio on that structure will be approximately Vega neutral, but the structure is long vol of vol. So if vol expands, you're going to get longer Vega. You started Vega neutral, you'll get longer Vega. And if vol collapses, you're going to get shorter Vega. So that is intrinsically a Volga, a long Volga position, a flat Vega neutral position. I understand that, but I never looked and said, how much Volga do I have? So I understood what kind of positions I wanted. Like I understood that if the market goes down X, I want to be longer vol. This is me being long Vanna. I never called it that. But it is what is implicitly happening.
So another question which I have is on volatility surface. I think it's going to be the last question for today.
Okay.
Yeah, I think we had a lot of discussion, a lot of topics which we have covered. Yeah, so last set of question which I have is on volatility term structure. Sorry, volatility term structure. So in what ways have you observed that a term structure behaving anomalously around major events, and how do you adjust your position accordingly?
Yeah. So term structure trading it's a very large part of vol trading because there can be different flows across the surface that have different end users and different requirements. So you may have vol sellers in the front of the vol curve. You may have hedgers in the back of the vol curve. So there is a real structural reasons why there should be opportunities in trading the term structure. So a couple things about term structure. I would use a multitude of ways of measuring it. The reason for that is well, I'll give you an example of some of the ways. A lot of them are ratio based. So, what's the 3-month vol relative to the 9-month vol? So you could have a set of ratios like that. And so you're kind of looking for anomalies in the ratio. the ratios themselves are a bit level dependent. Like what those ratio, like for example, when vol is very low, we expect an upward sloping curve. When vol is very high, we expect a downward sloping curve. So obviously, if you're just measuring ratios and thinking, oh, that's high or that's low, that's incredibly naive. Like you need to condition it upon like the vol level. So so ratios would be one example. But the other example is you could look at forward vols. So that's another way of looking. But one thing that's tricky about forward vols is that there's a many to one relationship between the legs that make up the forward and the forward. So I can have a forward vol of 30 because I have a completely flat vol term structure where every vol is 30. But I can also have a forward vol of 30 because my front month is 27 and my back month is 29. Well, for my back month to be 29, even though it's made up of but I know it's made up of a bunch of 27, means that the 27 that the interim vol, the forward vol, must be higher than 29 to average out to that. So I can get a 30 vol from an ascending term structure. I can get a 30 vol forward vol from a declining term structure using the same exact reasoning, right? So there's a many to one relationship between the legs and the forward vol. So if you look at forward vol naively or just by itself, you don't have a full picture at all. So you have ratios, you have forward vols, and then the other thing you can do is actually just compute the price of structures. So you can say, what is the price of a 30 delta, 10 delta call spread at various vols? And the reason for that, the reason it's a good idea to actually look at that kind of stuff is because if you just look at skew, it can be misleading because skew is also level dependent. It flattens as vol goes higher. So if you think about a call spread, if you increase the vol, all else equal, a call spread goes up in value, right? Because it's longer the near dated option or the closer option. But so the question is like, if vol goes up, but the skew flattens, right? That's going to push that where the far dated call goes up in value, that is going to lower the value of the call spread. You have competing effects. The skew flattening suppresses the call spread, the vol increasing increases the call spread. So sometimes just looking at the price of a structure at various vol level, like almost like a cloud scatter plot, is also revealing. So we always sort of like built tools where like, I don't believe any one way is the right way to look. I'm going to look at this from every angle. And then if all the angles agree, my conviction goes up. Most of the time, you have a lot of ambiguousness. There's a lot of things that are conflicting. And you're like, I don't have a strong feeling here. But I would say term structure, it makes sense as a place to look for opportunity because there are captive needs or in across a term structure, actually measuring the term structure. I wouldn't be pedantic about that. I would have a pretty open mind about the different ways you could measure that. So that's yeah. I would say, trading relative forward vols against each other and all that, like in a professional vol seat, that was a large part of what I was doing. And the other thing I should add to that is usually not it's not like you would go out and say, you would go quote it and be like, I want to buy this straddle spread and sell that straddle spread. Because a lot of times if you were to get down to the numbers, crossing the bid asks and all these things is going to wipe out a lot of your margin on what you think that forward vol spread that you're doing is. So it's more like I am an axed seller of this, a net buyer of this, a net seller of this one, and a net buyer of this one. And then you're out there just working all. So whenever somebody comes in to sell the thing you want to buy, you make sure that you're the best bid. Maybe you're a mid-market bid for that. So what happens is you are accumulating this trade that you want over time, and you're not paying to put it on. And so all of this lends is really a combination of I'm a position trader with a market maker perspective. I'm not a pure market maker, but I'm not a pure position trader who's just going to go line up where's this whole package offered and I'm going to go lift that offer, because I don't think you can make any money doing that. So which is kind of a testament to how efficient and tight sort of things are. Like you're kind of sitting in the middle of both of these worlds.
But I think the whole podcast was pure gold in terms of knowledge. Like you have covered different aspects of vol trading. You have went to even very practical stuff about which can be implemented by our listeners right into the market. And thank you so much for joining, Kristopher. It was a great conversation.
Absolute pleasure, man. Thank you.